Good evening, everyone. We'll make a start. Thank you all for coming. My name's Andrew Hewison. I just thought I would get up and just introduce our recently retired managing director, but chairman of Hewison Private Wealth. As the slide suggests there, John's discussion tonight is going to be on the financial planning industry and the future of financial advice. We should probably have sort of put out some rocky music to bring John in. It's a subject that he's fiercely passionate about, as are all of the stakeholders in Hewison Private Wealth. John's been a crusader for higher standards in the profession for many years. And no doubt he's going to have some very sort of interesting and colourful thoughts to share with you this evening. So afterwards we'll have some questions. I'll also stand up here with John and answer anything that is required. But John, over to you.
Thanks, Andrew. Evening, everybody. So no doubt you've all read a lot about the future of financial advice. It's been full of, the press has been full of it, and it's gathering some more momentum as we speak. But before I actually get onto the detail of FoFA, as it's affectionately known, I think it's important that we understand how the licensing system works in Australia, because it'll give you a better appreciation of what this whole issue about the future of advice and revision of standards is all about. So the licensing system in Australia is a principal agent system. In other words, the holder of an Australian financial services licence is the principal, and then the principal provides proper authorities, they're called, that authorises people to operate under that licence. But the licensee is absolutely responsible for everything the proper authority does. The complexity that comes from that is the institutionalisation of advice. And this will give you an idea of what the structure looks like. So this is the AFSL licensee, which could be a corporate structure, it could be a bank, could be an insurance company, could be any corporate entity. And then from that licence, not only can the corporate licensee license individual advisors, it can also license corporate advised representatives. So this is a company, and it authorises a company, and then the company authorises individuals as advisors. And you can start to understand the complexity of all this, and who the hell you're getting advice from, and who's responsible for the advice. And then of course down here we have the clients. So this whole issue about conflicts of interest, about kickbacks, about payments, about commissions, it all filters through this very complex system. By comparison, this is the independent model, which is the model that we operate. And it's simply that. You have the AFSL licensee, which is Hewison Private Wealth, and we deal with clients. And the clients deal with employees of the AFSL. So everybody knows who you're dealing with, who's responsible for the advice, and who is actually giving the advice. So from our point of view, we've been fighting tooth and nail to get the government and the regulator to understand that you cannot institutionalise financial advice. It's a bit like institutionalising accounting. You can't do it. And there have been many attempts to try and institutionalise accounting. The difference is that a corporation is only interested in profit. It's driven by profit, and particularly where it's a listed entity on the Australian Stock Exchange, it has to make profit, otherwise the share price will get slaughtered. Whereas an advice firm like ours is only interested in giving advice to the client. That's our only reason for being. Yeah, I mean, obviously we need to make a profit, But that's not our driven, that's not what drives us, where a corporate entity is driven purely by profit and keeping its shareholders happy. To illustrate this point, I just want to show you a couple of how this thing works and how complicated it becomes. This is the Commonwealth Bank. So the Commonwealth Bank is the AFSL corporate entity, and underneath the Commonwealth Bank, it has bought out other entities. Financial Wisdom, Count Financial, which is the largest accounting-based financial planning group in Australia, and Commonwealth Financial Planning itself, plus a whole heap of other entities, which I didn't bother putting them all up there because they've lots of different brand names. This is AMP. AMP owns Hillross, Charter Financial Planning, IPAC, Genesis, and of course AMP Financial Planning. I mean, this is massive, and the reality is that these large organisations control something in excess of 93% of all advisors in Australia. You're starting to see why the problems exist. And here we see even the Commonwealth Bank is under an enforceable undertaking and being forced to revisit advice given to some of their clients. AMP's been under 2 enforceable undertakings. National Australia Bank, you would have read in the last couple of days, is in trouble. And it's all about, and they can talk about rogue advisors all they bloody well like. The fact is, the AFSL, the licensee, is absolutely responsible for what the advisor says. So, wouldn't it be great if Glenn gave advice to one of our clients and it was improper advice? We told him he's a rogue. Not our fault. Oh, and it's just rubbish. So it's all about accountability, and it's all about being in control of what advice is given to clients and being in control of the cost to the client. And the issue with that is that there's all these mouths to feed. There are too many beaks in the trough. And the person that pays at the end of the day is the client. And some of the examples that we see, where people are paying 3% plus per annum and have no idea they're paying those fees because they're all hidden. They're all commissions, or they're volume bonuses, and all sorts of weird and wonderful things. But there's also this further complexity. And the further complexity is that there's not just the complex relationship between the licensee and the advisors, there's also these other entities like wrap accounts. If you invest through a corporate organisation, they will put you into a wrap account, which is an administration vehicle. And then there are managed funds that lay underneath that wrap account. So again, we have this additional complexity, and all of these mouths have to be fed. And the person that pays for that is the client. So this is why FoFA was arose by the Rudd government, Mark I, under the Ripoll inquiry. They first looked at these issues, and it was mainly around commissions. That was the main thrust, and these conflicts of interest. But there are other things involved. This is the Westpac structure, and I put this up to again illustrate that we have all of these different licensees, but we also have BT, which is a fund manager, but it also runs the biggest wrap account in Australia. Securitor, which is another wrap account, and Advanced Invesco, which is another wrap account. So that, again, there are all these complexities and different entities, and they all have their own corporate structures, and they all have to pay people. So at the end of the day, the client pays the price. And this is NAB. And NAB has a number of licensees. Coffee Pembroke, Van, also they own Goldman Sachs, JB Weir, and MLC is their main investment management wrap account. So again, this complexity and all these mouths to feed. Institutions are only interested in funds under management. They don't want to be in the advice business. They see the advice business as being their sales force. their conduit to get funds through into their wrap accounts and their managed funds. And we're talking about in excess of 500, we're probably talking about $1 trillion worth of funds under management. And you can imagine, if you're just taking a 50 basis points tick on $1 trillion, you're making a bit of dough. And that's why this is so important to them. But there's no money in advice for a corporate entity. So let's we'll move on from all of that palaver into FoFA. FoFA was first, as I said, came under the Ripoll inquiry, and some of its major initiatives were a ban on commissions and volume-based payments. Commissions consist of upfront commissions, so you invest money into a investment management product, and it'll pay the advisor a commission of 3%, something of that order. And then if the organisation has volume-based payments, and volume-based payments are to encourage the advisor to sell a certain investment, and the more they sell, the more they get paid. And then, of course, there are ongoing commissions called service commissions, which are no more than loyalty commissions. And the reason they were created back in the 90s were to stop advisors from switching from one product to another. So the fund manager pays them a trailing commission of something like 25 basis points, maybe 50 basis points a year. And over time, that builds into a very attractive amount of money for an advice group. So that the advice group is not going to be inclined to change investment because they'll lose their trailing commission. The next issue was fiduciary or best interest duty. Now, you know, this goes with the two. As far as we're concerned, we have a fiduciary duty. That's it. There's no argument. That's what we do. That's what, as professionals, our interest has to be the client first. Has to be. Otherwise, we're just fooling ourselves. But there are all sorts of issues with that. But they introduced the best interest duty. Then they introduced a fee for opting in for ongoing charges. So that if you had a relationship with a client where they were paying you an annual fee of some description, you had to provide them with a notification every 2 years saying, this is the service we're providing you, and this is what it's costing you. Are you happy to opt in? So this is the subtle difference between opt in and opt out is if the client doesn't return anything, the advisor has to stop the fees. It's not the other way around. If the client doesn't send it back, you continue your fees. So there was a great furor about this. The problem, of course, with the industry was that a lot of advisors were giving no service for the fee, and the client didn't even know they were paying the fee. So there was this massive anxiety. When we went to conferences and all we heard was saying, well, what am I going to do now? I've got to tell them what I'm charging them and tell them they're not getting any service for it. So again, problems. And then there was an annual fee disclosure statement, which you had to send out a notification every year saying, this is what we've charged you, and this is what we've given you for, which we automatically do every year in your tax packs. The clients of ours that are here, you get an annual invoice from us, a tax invoice saying what you've paid for the year. So these were the issues that the Ripoll report brought up, and that was included in the legislation that went to Parliament. When the current government came into power, they moved amendments to the FoFA legislation. In the first instance, they moved the best interest duty. Their contention was that there was already a law within the current Corporations Act that said that you must the advice must be reasonable and must be appropriate. Well, that's not fiduciary duty. You know, fiduciary duty is no conflict of interest. My advice is absolutely in the client's best interest, no question. So they're different things. So this is a problem as far as we're concerned. They removed the opt-in obligation, and you can imagine why. and they brought in a general advice exemption from commissions. Now this is dangerous, because what this is all about is when you go into a bank and the bank teller says, gee, you've got that, got all this money in your account, Mr. Smith, I think you should see one of our financial advisors. And I bet a lot of you have heard this come from bank tellers. Can I make an appointment for you? That's general advice. But what happens is the client says, okay, I'll see your advisor. That teller gets a kickback, gets a commission. So they're exempting that, which is absolute rubbish. I mean, it's just not right. Anyway, this was all disallowed by the Senate. The Senate threw it out and said, no, you're not going to do that. So we now have a situation where the compromises that have been reached are they've agreed to remove the best interest duty, which we're absolutely devastated about. They've removed the opt-in requirement, which is disgraceful. And let me tell you, it's not just the money. I'm an advisor, and I've been an advisor for 30 years. I've got $50 million worth of managed funds that are kicking me back 0.25% a year. That's 125 grand a year I get paid for nothing. So if I think one of my clients' investments is inappropriate or not doing well or could do better, do you think I'm going to advise the client to sell it? Absolutely not. I'm not going to lose my meal ticket, because if I do that, I lose the grandfathering condition of this training commission. So I think that the issue that I don't think the government understands that they're absolutely locking people in over $500 million worth of managed investment. They're locking in, and the client will not get the advice to sell if they need to sell, or shift to something else that's more appropriate. I mean, it's just absurd. I don't understand their thinking. Apart from the fact that the clients, just because it happened before 2013, the clients have got a right to know. And yet they've removed those conditions. So these issues are, they're part of the compromise, but there's a lot more happening at the moment. So the bill's still before the Senate, hasn't been passed, but we've now got a financial services inquiry, and it is coming out at the Murray inquiry, and it's coming out with some really, really strong statements about some of these issues, particularly the best interest duty, and they're talking about now other issues that I'll touch on. So maybe you can sort of get a sense of why we're so passionate about this and so angry about it. I mean, we could quite easily say, hey, what do we care? It's a market advantage for us because we don't do all this crap. So why would we worry about it? Well, you know, you've got a responsibility to the greater good of the community, don't you? I mean, this is just a legalised rip-off in our view. So what are the big issues? The big issues are the grandfathering of existing arrangements, which I've just talked about, the grandfathering of training commissions, the grandfathering of the lack of accountability in terms of making clients aware of what they're paying and what they're paying for. The fiduciary obligation is absolutely mandated. It has to come into being. Otherwise, we're kidding ourselves. To call ourselves a profession, fiduciary duty is absolutely essential. Education standard. Somebody asked me before what this little pin is, just CFP. This is a certified financial planners pin. We're all certified financial planners, and certified financial planners it's a globally recognised professional designation. In this country, you have to have a university degree, you have to have done a postgraduate specialist course, and you have to do a 4-unit master's, 5-unit has been told. 5, it was 4, and I did.
They got away with 4, I did the 5th one.
A 5-unit master's degree level professional course. Takes you 5 years, unless you're very, very smart, but even so. So basically there's about 8 years of study that's required.
John, sorry, Stu. the reality is that you're talking about that side, and I feel that the unfortunate situation for people who sit on the other side is a client, and every business is based on trust. So if you're happy with your Commonwealth Bank teller, and you're happy with your Commonwealth lender, and you're happy in my case with your accountant, and your accountant says to you, Maria, look, we've got a really good show here, and then, you know, they've come top in, you know, whatever. So ignoramus says, I trust you, you know, our relationship has been built. So based on that relationship, you then trust the other layer who comes recommended by someone you trust. And then most of us are now educated, but most of us have no idea what's happening behind the scenes. You're seeing bottom lines, and you're patted on the head, and you're told by people very sweetly that everything's okay. And, you know, it's the education on this side is equally important, because we've got to make intelligent decisions based on a whole lot of stuff that most of us don't want to know about, because we want to give it to an advisor. All we want to know is if we've made money. Well, that's all I want to know. I want to travel, and I want to make money. And I would say most of you are in the same boat. So how do we then, I mean, we're the lucky ones, we're educated, we've got a process that's in hand. How do you get the poor mum and dads who are sitting there going, well, you know, heck, you know, so we've lost $1 million, but it's okay, because our advisor will get it back. That's my concern, because I come from a social equity background. It doesn't worry me that I'm doing well. It worries me that a lot of people are not.
Yeah, well, it's a very good point, and the fallout is that a pathetically low number of Australians seek financial advice because they're scared, and you can't blame them. I mean, you read all this stuff in the paper every day, which is infuriating. There are a lot of very good professional financial planners. I mean, there are 10,000 members of the Financial Planning Association, and all those people have to sign up to get this PIN. Otherwise, they can't qualify to join. But the media coverage of all the things that have gone down over the past few years has made people very sceptical and very scared, and you can't blame them. And until we get the right messages being the right standards in place to start with, and the right messages being conveyed to the great public, I agree with you entirely. I mean, it's pretty sad when you think about the people can't trust the financial planning community to get quality advice, and therefore too frightened to go and seek it.
Well, if you're in business, you have a criteria for employing someone. If you don't know what the criteria is, and you have no idea what you're looking for.
Yeah, well, it's true. Yeah. Education standards. I've told you what our standards are. I'll tell you what the regulation standard is. It's a half a diploma that you could do a fast track course online and probably get it in about 4 weeks. That's the regulation standard. It's absolute bloody disgrace. And I can tell you that in my history of involvement with the Financial Planning Association, when I was on the board, we had regular meetings with ASIC, and we thumped the table and said, this has just got to stop. We've been pushing for degree-based education standards for the best part of 20 years, and no one wants to listen. It's just disgraceful, because they're catering to the broader community. This is the problem, that to change all of this means a major change to the structure of as I said to you before, 93% of the financial advisors work for institutions. So to break that mould, to break that structure, is going to cause havoc. Too bloody bad. You know, we could have just given everybody 3 years to get it right, but now we've wasted that time, and the chickens are hopefully coming home to roost. But in the meantime, as Maria points out, the greater community's just lost faith, and I think it's sad. Our view is that there needs to be separation, recognising that the institutions that manufacture product have got a right to sell their product. I don't have a problem with that. We don't have a problem with that. But how about saying to the community, this person here is licensed to sell your product, and this person here is licensed and educated to give you advice on your financial future. There needs to be a separation, so you know who you're talking to. I mean, if you walk into a Ford dealership, you're going to expect to be sold a Ford. Nothing wrong with that, it's still a car. And if you go into a bank or an AMP or somebody, and you want to buy a life insurance policy or you want to buy something or other, they're going to sell you their own product. That's okay, but it's not advice, and it's not serious advice. It's just buying a product. And for a lot of people, that's all they want. If all they want is to buy a life insurance policy is a life insurance policy. You're dead, you're dead. I mean, that's it. So it's not hard to get that sort of product sale. But to try and get estate planning advice and everything else that goes along with that, and all the complexities and the tax issues, and when that takes an advisor that's got some years of education and experience. So if that was the first step, that we had a division that said, right, you go to a bank, they're going to be a product advisor. If you want to go and see somebody who can really give you proper financial advice, they need to have this licence. That'd be a good starting point. Fortunately, the financial systems inquiry is recognising all of these issues, and the politicians are all over it. You would have read in the last week or so, there are a number of politicians from various parties saying the education has to change, it's got to be degree-based, blah, 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 blah. You're right onto the co-regulation model that the Financial Planning Association put up. ASIC can't regulate. They haven't got the resources, they've got the knowledge, they've got the money. Whereas a Financial Planning Association have individual planner members, they can introduce audit, they've got disciplinary processes, code of ethics, code of practicing standards, everything's in place. If they were given the co-regulatory model with ASIC, then we might have a solution that'll work. And as far as I'm concerned, and I was one of my hobby horses when I was on the board of the FPA, every financial advisor must be audited every 3 years at their own cost. And if you're an accountant, a CPA, you get audited every so many years and you've got to pay for it. Nothing wrong with that. And we spend a fortune. I'm not trying to sell us, but we spend a fortune. When I looked at that Four Corners program, was it Four Corners on the CBA?
Thank you, Matt.
And that guy, the compliance manager of CBA admitted they had 1.5 compliance people for 1,000 advisors. Can you believe that? We've got more here with 6. It's just ridiculous. So it's accountability. They can't afford it. That's the problem. If you're going to try and put in compliance measures and supervision for 1,000 or more than that advisors Australia-wide, you need 100 compliance people and all sorts of proper systems and procedures. Anyway, I won't bang on about that, but that's the problem. So look, I'm going to leave it there and pass it over to you. I'm happy to and Andrew and I'll take any questions that you might have or anything we can clarify. Yeah.
2 questions. Definition of a wrap account, first one, please. And I'm interested in the statement you made, scared to receive financial advice. John and Jill Citizen from a CFPA. I wonder if you've dug deeper into that as to why it comes about. People are reticent or hesitant, or is it just your assumption that they're scared they're going to be led by the nose down some path? So there are the 2 questions.
Okay. A wrap account is an administration platform. So what it does is it wraps. If you go to the financial advisor, they'll give you a portfolio of investments. So they can either say, here are your investments, hand them to you, and you go home with a handful of investments.
So I've got a wrap account.
No, ours isn't a wrap account. It's a different animal altogether. A wrap account doesn't do anything other than report on your investments. That's all it does. But it's just a mechanism. It's got no front end to it at all. But they charge for it. And they charge anything from 0.45 to 100 basis points a year. And the advisor gets a kickback on that. The more they put in, take it back. So
And
all
the-
it is administration.
And the added complexity to a wrap account or platform is that the products that are placed, managed funds, etc., that are placed within the wrap account, they pay to be there. They pay a
Really?
shelf space fee to be there.
Really?
Yeah. So that's another layer of fees that gets passed through to the client if they're in a wrap account structure. And the problem with that is you've got an issue around conflict of interest because the advisor can only recommend investments that sit within the wrap account. And if those investments are paid to be there, then you've got a problem.
And unwrapping is the interesting part. You haven't got a pair of scissors because we've been unwrapping for a few months.
We have.
And I'm insulted by the level of wrapping that took place in a number of years where I was very complacent for other reasons. And being unwrapped showed me, or how to unwrap showed me the integrity or lack of the advisor that I've been using for a number of years.
So Ken, what's the other part of your question?
Well, I was interested in the statement of John Hewison is scared to receive financial advice.
They've been hurt.
Or is it a bit like a lot of people not wanting to go, don't want to go to the dentist? It's a bit like that.
Yeah.
Yeah.
Don't
want
want
to know
I
about,
mean, I don't want to go and get advice from somebody who might lose my money. Yeah. And a lot of
It's
people got
lack of
hurt.
education. We are fools. I'm an educated woman and I've just learned in the last year how to do some of the stuff thanks to people who have cared enough to educate me.
I think the issue there too is it's like, I mean, many of us are professionals in our chosen profession or industry. I mean, I go to a dentist or a doctor, I have no idea what they're going to do to me, what they're going to prescribe. It's a complex field and they've studied for many years to do that, but we, as a community, we understand that. And therefore there's an implied trust before you even walk through the door. And what John's alluding to in relation to, I feel you're perhaps being a little harsh on yourself and others to say, well, we're fools for not being educated. I think where as a community, where we're being let down is in the standards. You know, as John mentioned, the half a diploma, and all of a sudden you can be thrust in front of a client, and that client is expected to trust what you're saying is in their best interest. I think that's where the problem lies.
I'll just make a comment just in relation to the doctor model. I think a lot of us would feel different if that general practitioner that we went and saw was owned by a pharmaceutical company.
Yes.
What do you think they're going to do? Like that's where the conflict comes in, and that's where you might lose faith, and that's what's happening in our industry. It's the same thing.
And I think, I mean, also Ken, just going back to your question, there, a lot of people got hurt in the last few years with the financial crisis, being put in inappropriate investments that went bad and didn't recover, advisors running for cover because they didn't want to face up. You know, we heard a lot of that where advisors just wouldn't answer the phone because they knew they were just going to get abused. So a lot of that went on.
John, you talk about advice, and we understand that. You can't give advice unless you have some objectives. What the regulations, current or future, how much emphasis is given on knowing what the objectives are of the client? It seems to me that those objectives need to change over a client's life. And you can't give advice unless you know. Technically, you can't give advice unless you know.
The industry has been based on risk assessment. That's been the basis of advice. So you go and see an advisor, they'll give you a questionnaire, and you fill it in, and they'll go tick, 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 tick. Yeah, you're a 12 out of 20, so that makes you a risk-averse investor. So we'll plug you into our computer, and they'll spit out a portfolio for a risk-averse investor. That's what you get. Nothing to do with objectives. So now, of course, all that's now been seen to it didn't work. So now the new catch cry in the industry is objective-based advice.
Yeah.
We've always, and there is no other advice except objective-based advice. I mean, you could have in the first place, everybody's a risk-averse investor. I don't care who you ask. I mean, Our biggest client said was, don't lose our money. Don't put me at risk of losing my money. I mean, everyone's risk averse, but when times are good, the markets are running, everybody all of a sudden becomes risk tolerant. Let's put some more money into the share market. Right? Let's take some more risk. And it's up to us to say, no, this is the model we've put in place in order for you to reach your objectives, and we'll rebalance to that model all the time. We'll take profits and we'll buy low, and at the end of the day, we will reach your objective. We're not going to expose you to more risk. Now, obviously, if the client insists, we can negotiate. But the reality is that the only advice is objective advice, and that's the character of investment, and that's what you do it for. You do it to get to a certain point, to achieve a certain outcome. It's not about the investment. It's not just what we read on the investment of the day, come and buy it, but that's what a lot of advisors do. So, I mean, it's an absolutely fundamental point, Ken, and it's just interesting to see now the industry talking up this objective, but I don't know how they're going to do it. Because one of the issues that they've got, when you've got an institutional model and you've got advisors spread all over the country, how are you going to control what they're advising unless you have something, some mechanism that controls how much risk they're going to take, and then some basis to defend yourself when it all goes pear-shaped and the client complains. And I don't know how they're going to put objective-based advice in some sort of a control model. So, you know, again, I mean, that's what advice should be about.
In saying that, I mean, that's precisely, you know, it kind of goes hand in glove with the comment about CBA and the 1.5 compliance people per 1,000 advisors. I mean, they're going to you want to start with a few more compliance people if you're going to go down, a larger institution was going to go down the path of objective-based advice.
There's two quick things. You both referred to the financial planning industry. Well, it's a profession, not an industry. Number two, CPA Australia only audit those members that have a public practice certificate. Now, the problem with their compliance model is they do it every 5 years, that's fine, but you can be audited by the accountant next door or the accountant in the next suburb, and that accountant auditing you goes through your files. So there's a really big conflict there. So it's not flawless by any means, and that's the reason why their compliance staff, well, they aren't compliance staff, all they are just graduated accountants. They're not compliance staff at all. They see a report come in, we'll have to do something about this. Usually it's straight to disciplinary, depending how bad it is, or they write for some assurance. Not a real good compliance model.
Yeah. Well, I wasn't suggesting we should duplicate the CPA model, but if it's on a user-pays basis, they can have as many compliance people, qualified compliance people as they like. For example, again, I'm not talking us up, I'm just using this as an example. We employ external compliance lawyers who come in and audit our business entirely for compliance once a year, and every 2 years they spot audit all of our files, or not all of our files, randomly selected files, to make sure that the advice we're giving is appropriate. One of those lawyers sits on our compliance committee, which is Glenn and Chris Morcom, both on that committee, and Effie. I mean, it's full on. But you know, it's just best business practice. It's nothing to do with obligation that you've got to do it. I mean, we've got to be careful that we get it right, and I don't see any issue with that. It's a cost of doing business. So I mean, I'm sure that model can work, and work, Peter, with appropriately qualified compliance people.
John, what are the vast majority of investors argue against the fiduciary obligation? I can't understand why the fundamental issue that you do things in the interest of your client. It's like, you know, you believe in God, you've got to do it. What is the argument against that?
The problem is that if you manufacture a product and you're also giving advice, there is no way on earth that you can fulfil a fiduciary obligation because you've got a conflict of interest.
So there's no, in principle, not against, fiduciary obligations, but they have this conflict.
Yeah. So what we'll see happen, I think, is the institutions splitting away their advice businesses and having some other mechanism in place to get loyalty. But as it is, and that's why it's been pulled, because of the lobby by the institutions in Canberra. They're convinced the politicians that this just ain't going to work, and the whole world will explode if they do it. But I think they're going to be stuck with it whether they like it or not. It's not just a matter of being seen to be a fiduciary. You have to be a fiduciary with no conflict of interest.
This boggles the mind, really.
Yeah, very complex.
John, going back to what some of the people said, to get the confidence if you're going to leave work or whichever way, how do you promote the fact, I've been with you some 15 odd years, I walked out, got made redundant, had a nice cheque in my hand, what do I do? Where do I go? I was with the oil industry and they pushed me towards the institutions, such as the banks and others, and I went to them and didn't feel comfortable with what I was being told. I was able to go through John through word of mouth. And coming to you, yeah, everything's been good since then. And it's sort of like a family support. These guys are pretty good at, I mean, just talk with Nathan. How do you promote that out to the people outside? How does the industry, your industry, promote that? Is it word of mouth? I've told a few people whether they come to you, that's their choice. But you hear so many different people, I've gone to the bank, it's easier. Or I trust the bank because I get the best interest. How is the energy there to promote it to the person that is going to retire tomorrow and doesn't know where to go? Is there any promotional thing there?
Oh, I mean, from our personal point of view, I mean, this business of 30 years has been built on the reliance of the fact that we try to do the best we can for our clients, and we rely on them to if they feel comfortable to use that word of mouth. It's very hard to convey that kind of message through an advertisement, which is why we don't advertise. So it's not, I mean, we also rely heavily, I believe, on the work that the Financial Planning Association does, but they have limitations on their resources, particularly, you know, with the promotion of the CFP designation. You know, it does mean a lot to us to have gone through the hard work to do that, to get that education. But very, very rarely do any of us ever get asked when we see a new client, are you a CFP, which is a concern because they haven't, it's not like a CPA. I mean, the CPA have some great marketing around and they've got the resources to do that. And again, we can't, I mean, from a personal point of view, I can't begrudge someone who's been with a large bank, one of the big four for 50 years, and seemingly that bank has done the right thing by the individual. That's why, for me, it comes back to the education standards or the regulation.
I think it also is about horses for courses. I don't like going to my dentist to have my teeth done, but I sure as hell am not going to do it. I'm going there for other purposes. And it's being able to identify what you're after, what product, and who's best to provide that product. And I come from a ignorant point of view where I staggered through until I was surprised, you know, and I interviewed a lot of people. But most people go from trust of one thing, the bank's been looking after my money, the bank says this is the way we go, and it's so easy. Most of us are very lazy about money, we just think it's easy. And it's only when you realise just how many pitfalls there are that you realise it's better to do the homework. And I know quite a few wealthy people that I'm saying to them, wait another year. If I'm driving my Maserati, then you can come on board because it's obviously working. Don't take my word for it. Just watch what I drive.
Did you get that, Ken? Objective-based advice?
I agree with objectives. I'm keen on objectives.
But you know, I'm not going to get that trust from people who are in brick and mortar all their lives. They're going to say to me, well, I'm making money on my brick and mortar, and I say, well, did you buy Maserati? Hey, I've got enough now confidence in what I'm buying. But 12 months ago, I was giving you guys a really hard time because I had no idea the questions to ask, but I knew what I didn't even know what my objectives were. So you educated me to ask the right questions, and then you fed me the answers, which, because I'm not that stupid, I figured that you were the right people. That's where, you know, okay, by default we're here. Lucky people.
I think that's one of the things.
I bumped every percentage on this.
I think that's one of the other things that we're sort of moving heavily. We've always been objective based, but we're emphasising much more this recognition of concentrating on the outcomes rather than the way to get the outcomes. I mean, that's what we do. And that's what you expect us to do. But we really need to focus on where we want to get to and how we're going to get there.
I think, you know, just finishing off on that point in relation to the everyone plays a role, as John mentioned. The banks and the large institutions, the product providers, they do play a role. But I mean, we're sort of fighting a battle against a very powerful source that have a lot at stake in relation to, as John alluded to the amount of money that they make from, well, it's from the product manufacturing, but ultimately the consumer and the client. And I just go back to, again, that's why, you know, John personally and these business campaigns, I mean, as you said, this isn't it's not a sell job. We're selling to the converter for the most part anyway, but this is looking at the broader market around how can we make sure that more people who aren't seeing Hewison Private Wealth or a number of other very reputable independent businesses around Australia, how do they get looked after? And that's why we feel that the regulators have a great deal more responsibility to deliver it. One more, yeah.
I'm just wondering, how did anybody find you guys? Because, I mean, I know when I was looking for a financial advisor, I Googled you.
Yeah.
I just said financial planner and you came up.
Yeah.
Because we'd seen all these other people bring our money with that.
Yeah. Well, it's really funny. The rate of online inquiry that we've been receiving over the last 12 to 18 months has been absolutely phenomenal. So, I mean, the internet is now a source for people to, you know, educate themselves, and I guess if there is a way, if they have picked up through the Fin Review or something else like that, you know, some key things to look for, whether it be independence or whatever, we're receiving a lot of inquiry just from people typing in independence, and thankfully we're popping up. But for many years our business has grown through word of mouth and also through professional colleagues. So because we are, you know, wealth management, financial planning in isolation, as Maria alluded to before, you know, some financial planning businesses have accounting and have legal, and that's fine as a business model. But on the basis that we know what we're very good at and we just stick to that, you know, we receive a lot of referrals from independent accountants who aren't aligned with other financial planning businesses and so forth. So, as I said before, I mean, if we had the golden ticket, if we knew exactly how to tap into everyone, then, you know, obviously they'd be better off, but we'd be better off as well. I mean, if we knew how to do that, it'd be fantastic. But at the moment, as I said, you know, the relationships that we have are built on trust, and it's very hard to put "trust me" in a financial review advertisement, you know. So it's a challenge. There's no doubt about that.
What do you do about educating people out there?
Well, we do a lot. I mean, a lot of these seminars, admittedly, we do wind up with, for the most part, our clients coming. But when we promote these seminars from an educational point of view, I mean, this has been a very unique seminar. A lot of our seminars are tailored towards different aspects of wealth creation, retirement, estate planning, etc. And we've also done a number of young wealth seminars as well, which will continue on because it's very important for the younger generation as well. I mean, I've got a personal belief that, I think some of the core, the core personal areas where young people should be educated at a young age are being completely missed out on. And one of them is understanding areas of finance. I mean, until I went to university, and I didn't really learn, there wasn't a particular course. So I think that from an educational point of view, that's where it'll be a good start. But we do see ourselves as having a responsibility to try and educate the broader market outside of our own client base. No doubt about that. I mean, that's why we produce blogs once a week that are on very, very, very broad range of topics. And you know, we hope to grow our database over time so more and more people can educate themselves just off our blogs.
John, finish off with what's your 30-year gut feeling where we're going to end up with all this mess?
Okay, my gut feeling is that the government will legislate co-regulation between not necessarily just the Financial Planning Association, but right at the moment the Financial Planning Association is the only organisation that has all of the things in place that's required of a professional body, and they've just applied to the Professional Standards Council to be recognised as a profession, which we've been talking about for 10 years, so that'd be a good start. So I think that'll happen, which is great from a compliance sort of audit point of view. I think the fiduciary duty will get in, and then that will change the whole fabric of the not the profession, the broader industry, the structure. We're already seeing a lot of breakaway from the institutions, and the institutions themselves now calling from which of the banks just in the last week have said we're introducing degree-based education standards.
I think AMP did that a little while ago.
AMP did it. AMP's done a great job in this area of education standards. In fact, my friend Steve Helmich from AMP is the current chairman of the board of the Financial Planning Standards Board, the global organisation governing the CFP standard. So he's done a great job.
My ex-advisor was a very well-educated person, but he was locked into a rap and a model and kickbacks and, I guess, loyalty to his own objectives, which was to be very wealthy by a very short time. So education isn't just, I mean, I agree with you, education's important. However, we need to break that kickback loyalty, which enables you to service your client as opposed to servicing yourself.
That's effectively been done. The commission system's been legislated against, except for the grandfathering part, which we think is totally wrong. But that's another matter. But for going forward, you cannot now receive commissions. They'll receive it in a different way. They'll call it something else. But if it's at least if it takes the product price out, and I do think there'll be a separate licensing category for product sales and a separate licensing category for advice profession. An advice profession will have to be degree based. I feel like everybody's jumped on that bandwagon. What was the quote last week? One of the politicians said that the current system just encourages shysters and books or something or other. So the pollies are all over it. So I think we'll see degree-based education. I mean, it's all part. Look, education is not just one part of the story. Watch this space. I think the outcome will be pretty good, but it's going to take time.
Are there any publications put out giving statistics on private companies as yours compared to multinational things, comparing your performance compared to the big companies as what you earn for the client?
Yeah, we
rate on a list of where you come as Hewison.
Well, I mean, every one of all of you who are clients know your portfolio is unique to you. So we don't have a model portfolio or anything. The portfolios are individually designed. So to have a performance rate is difficult for us, although we take a survey, a random survey of 100 accounts, and we calculate our average earning rate each quarter, and then we compare that against the industry performance figures.
But isn't it tainted somewhat? And I've been told in the past, I think 25% off. What was explained to me was the amount of costs that were being filtered out, and bottom lines were very rarely discussed. So you can play, every industry has its little game of playing with it. You know, we've got a percentage of unemployed according to whoever's going into. So, you know, it's really hard to talk about, you know, those sort of numbers because everyone can play with them.
Yeah, certainly the published performance rates are gross before fees.
John? I think it's also to point out, going back to the objective-based advice, we're designing a portfolio to achieve your objectives, not necessarily to get the absolute best performance, because with greater performance comes greater risk, so it might not be appropriate for everybody to be chasing the highest performance there is. We design the portfolio to achieve what you need to achieve.
And one of the biggest objectives we have is protect you from getting hurt. And chasing high returns doesn't necessarily mean you're being protected from being hurt.
Oh, ladies and gentlemen, did you have a question?
No,
the hand was going up and down.
My phone rang and sort of lost the moment. What I was going to say, John, was that a number of our friends have said to us, "Are you paying them all that money?" And I think what they sometimes don't realise that when they go in a different direction with a different organisation, they're actually paying maybe even more, and it's just concealed in such a way that they don't really understand. And we say, well, if we're getting a good result, we're not happy about paying the commission that we pay.
Oh, go on, Barbara. Of course you are.
And it's a fee, by the way, not a commission. That's what the whole thing's been about.
I mean, we're not ecstatic about it, we'd love it to be less. We can see that if we're getting what we want, it's probably worth it. So,
Yeah, I think, and the issue is transparency.
Yeah.
I mean, you need to know what you're paying.
Yeah.
And at the end of the day, we're accountable.
Yeah.
And I'm sure Chris has said that to you. I mean,
Yeah.
if we don't perform and you don't get the results you want,
we
then
let
you
you know.
then you simply sack us.
It's actually from the advisors. I'm sure they've shared this comment that it's one of our biggest challenges at the moment because of and we look forward to the challenge. Honestly, we look forward to the challenge of actually hearing a new prospective client come and see us and say they're seeing a number of other advisors, because it's really good that if we're successful that we know that we've been benchmarked and that we've been successful, and but in many cases the individual is making a comment in relation to fees. And we're having to send them back to the other advisors and say, here's a list of questions you need to ask in relation to, okay, so this is the fee you quoted me, can you let me know where these other fees lie? And invariably they come back and say they're almost twice as expensive as you.
It's something, do you go to a tailor to have something made purpose built, or do you go to somebody off the rack? And there's the difference. Often you're not comparing apples from apples, and you need to put that distinction into place.
And look, you know, we're not for everyone either. And so there needs to be other advice providers out there who can cater to the masses, so to speak, because there are some, with getting advice, well, I won't say getting any advice is better than getting no advice, because no one wants bad advice, and that's what that's why we're coming back to the topic at large. But we can't be everything to everybody, but certainly we're the right fit for some people. So.
Yeah, I think it's also an attitude now. I don't want to be sounding like we're selling something, but I can tell you in all sincerity that we don't pitch our fees based on how much we can make. We don't pitch how much we can get away with. We pitch our fees on the basis of how we can provide the service we want to provide and make a reasonable profit, and that's it.
Business.
And generally speaking, we obviously know the market, and we know, generally speaking, that we're very competitive, but we provide a better service. And I mean, that's just telling you the truth as it is.
I think, John, what you said before, transparency is a key. Most of us feel very comfortable because we know exactly what's happening. Whereas the previous, you never really knew where you stood. You saw the figures, and not sometimes better or worse, but you never had the feeling, I know exactly what's going. You guys, we know what's going. So that's the beauty. And I'm willing to pay for it.
Yep. Yeah, and you can be comfortable if you feel like you're getting the quality for what you're paying.
Well, thank you very much, ladies and gentlemen. I think by the calibre of the questions that came back, we should all thank John for the quality of his presentation. It was fantastic.